Greetings. My name is DeAndre Sinet. The purpose of this video is to satisfy the group presentation portion of our final group report for my CIDM 6355 data mining course. Coincidentally, our group name is DataMiners. And as a group, we decided to create a stock price prediction model. Actually, we created three different models. The reason we chose a stock price prediction model is because we know studies show that 33% of investors do in fact lose money in the stock market. So it is our hopes that one of these models, if not all, will help the average investor get out of that 33% and perhaps even make money in the stock market.
Thank you, DeAndre. Hi, the stock markets go up and down. A professional investors beat the general market over the long term. And ordinary investors like you can also beat the market if you have right information that gives you an edge. That's where we come in help you with our high performance stock prediction model. Hello, this is Mohammed Kader. I'm part of this data miner project where we are a team of 5 developed prediction model to predict the stock prices. In our project team consists of first myself, Mohammed Kader, and we have DeAndre, Carlos, Nisar, and finally Brittany. We developed model using naive Bayes, neural network, and regression analysis, and compared the performance metrics for each model. Before each of us talk detail about the models, I would like to quickly go over the data preparation step that we used in the project. So the stock data can be classified into 2 categories. One, stock profile data and stock technical indicator data. The stock profile data is the data that we get it daily from the stock market. The data include, but not limited to, ticker symbol, closing price of the stock, and the volume or the number of stocks traded on that day. Next, the technical indicators are the class of metrics whose values are derived from general price activity of the stock. So it can be used to predict the future price levels of the stock by looking at the past patterns. So we have used limited technical indicators in our project. So the exponential moving average, the rate of change, the relative strength indicator, and the moving average conversion divergence indicator. So let me go over the pre-processing steps of the data. In order for our project's classification model to work, we needed to code the data. The symbolic values such as ticker symbol, sector were coded to the numeric values. So the pre-processing step, since we are using 26,000 records, we have used Java programming language to process the data to populate the values of some of the columns. So the data then divided into 90-10 split, which is 90% of the data was used to train the model, and 10% of the data were used for testing purpose to test the performance of the model. With the data being ready, let us look at the details of the actual model from our other project members here. So let me now hand over to DeAndre. Thank you all for listening.
The stock price prediction models that we created are the linear regression model, the neural network model, as well as a naive Bayes model. The naive Bayes model will be the focus of this particular video. Now, the naive Bayes model that we created was built using RapidMiner software as well as the R programming language. Now, both of those will be the topic of this particular video, and the performance percentages for both models created in RapidMiner software as well as in the R programming language generated the same performance percentage results. So I'll be talking about those one and the same within the same video. Naive Bayes model. It's used to predict probability. The name naive Bayes itself, Bayes, that part of the name, it comes from an 18th century preacher who was also a mathematician who dealt with conditional probabilities. The naive part is an assumption that each variable is independent of each other with respect to the target variable. Now, the reason we chose naive Bayes model is because it can make predictions about many combinations of variables that have never been seen. In our case, we have 10 predictor variables and one target variable. That target variable is determined whether or not a stock price will increase or decrease. Okay, when we built the model, the naive Bayes model, we used a 90-10 data split, which means that 90% of our data was used for training data set and 10% of our data was used for the testing data set. Once we built the model, we generated a confusion matrix, and within this confusion matrix, we have our performance percentages. We have accuracy, precision, and recall. The accuracy is the percentage of stocks that were correctly predicted. The precision is how useful the prediction results are, and the recall measures the completeness of prediction results. Our accuracy was 79%, our precision was around 88%, and our recall was about 70%. What do these numbers mean? Well, to break it down even further, this means that for every 8.8 stocks out of a sample of 10, there is close to a 70% chance the prediction is precise and complete. Now, what does this mean to the average investor? How does this have a real-life application with the naive Bayes model? Well, it is our hope that they would be able to take, as I said before, a random sample of 10 stocks, take the model that we've created with our training data set, plug those 10 samples in, and have a better prediction of whether a stock will go up or down based on our performance percentages. In conclusion, I would like to say that this particular model is relative to our other models. The validity of this naive Bayes is relative to our other models, that is to say our linear regression model as well as our neural network model. Something I will point out, and that is of note, is that our neural network model actually did, as far as performance percentages are concerned, a lot better. Well, the percentages are higher than they are in the naive Bayes model. I hope this video was informative and that you enjoyed it. Happy holidays, everyone.
Hi, my name is Nasar Kamal. This video is part of a series of short videos our team has put together as part of the data mining course project work. In this video, I'm going to talk about neural network model we built to predict the upward-downward movement of stock price based on historical price data. Artificial neural network, or neural networks in general, is an attempt to simulate the working of biological neural network using digital computers. Biological neural networks of the human brain can generalize from experience and is quite powerful, whereas the digital computers excel at performing repetitive tasks over and over. Neural network attempts to bridge this gap, and when used in well-defined domains such as fraud detection, diagnosing medical conditions, their ability to generalize and learn from data mimics that of the human brain to learn from experience. Neural networks are a class of powerful, flexible, general-purpose technique that can be applied for prediction and classification and is a very useful tool in data mining. However, it is not without its drawbacks. Neural network models can become quite complex for the simplest of cases, and training a neural network model results in internal weights distributed throughout the network, making it difficult to understand why a solution is valid. In this project, we used the neural network to model financial time series data for the purpose of prediction. We built these models using RapidMiner software and R programming language using the same dataset. We split our dataset of nearly 26,000 observations into two groups, with approximately 90% of the data being used to train our model and the other 10% is used to validate the model. We captured accuracy, precision, and recall metrics that could be used to determine how well the model is able to correctly predict the movement of a stock price in an upward or downward fashion. The metrics generated by RapidMiner and R vary quite drastically between the models generated in RapidMiner and R. For example, the accuracy of the model built using RapidMiner is 90%, whereas the accuracy of the model built using R is just 48%. As I mentioned earlier, these models can get very complex and hard to decode. When compared against the model built using naive Bayes, we get a similar result as that of the model built using RapidMiner and neural net. Given that we assume that more work needs to be done on the R neural net model to determine the cause of low accuracy. Thanks for watching.
My name is Carlos Martinez, and I'm going to be going over the way we built a linear regression model and a time series model in RapidMiner. The first step that we did was build a call structure in VBA to hit Yahoo servers to download CSV files. Each CSV file contained the ticker of a company that we chose, the high, the low, the open, and the close price for the specific period of time. We did this over 40 years time span, and we specified the S&P 500 indexes to mine our data. To be able to join the data set, we use SQL Server integration services, and we normalize the data into specific tables. Once we normalize the data, we use the relational database management system engine inside SQL to build an analysis service cube. This is usually an OLAP cube, and what it allows you to do is it allows you to mine the data by different attributes at a much faster speed than you would in traditional SQL. And it also allows you to leverage it by not having to go through extensive SQL statement writing, etc. Once we had the data normalized inside a cube, we use RapidMiner to build a time series model. Our thoughts are on the basis that markets are becoming more and more defined by current state volatility and longer term trend following approaches. And when we mean markets, we mean any asset class, whether it be oil, whether it be equities, whether it be bonds. In its purest level, it's an asset that is trending, whether it's up or down or sideways. We use the RapidMiner moving average as a prediction model to be able to say, well, if the stock or the equity falls beyond this line, then that would trigger a sell signal, and if it would go above the line, it would trigger a buy signal. What we have in mind is using this in a much longer time span, kind of like the IV portfolio that's written about extensively. And what it does is that it gives you 8 to 10 month aggregate of data, and it creates a lag on that. The reason we feel that this is superior is because as investors, we would avoid most of the sharp drawdowns of volatility, especially in the short term, and we would be able to capitalize on the longer term. We felt that the use of RapidMiner to build a time series model was great, and the ability for us to build an OLAP to feed into RapidMiner really leveraged our data mining skills and helped us get a very strong foundation on predictive modeling for stock prices.
Hi, my name is Brittany Ayers, and I'll be discussing the conclusion of our project. The average investor typically make an investment decision based on incomplete information, tips, screw reports, and type of spur of the moment type of feeling. Using predictive models, as in this project, can be risky because of the unknowns that are not accounted for. Since we cannot account for every unknown due to the fact that our economy has what I describe as a up and down yo-yo effect, predictive models are not 100% reliable. This group project gave our team the chance to use real data that we collected from Yahoo servers and apply it to models as discussed in earlier videos from our teammates. We used the naive Bayes, linear regression, and we also used the neural network models. We believe that a moving average approach as a passive investment management discipline in which could help investors avoid sharp drawdowns in volatile markets and preserve capital. If we present these models to a company, we want to stress the fact that if the stock market drops below a certain indicator, it triggers the investors, hey, now's a good time to actually, sell some stock. If it's above a certain line, we want to indicate that, hey, it's time for the investors to actually buy in some of the stocks. When the models are used long term, we strongly believe, based off our accuracy performance rate from each model, that our approach will help investors preserve capital in trend markets. This project allowed us to take data and compare it across 3 models, not only using RapidMiner, but also reassuring our outcomes by using our programming. Taking consideration accuracy indicates the percentage of stocks correctly predicted. Our naive base gave us an accuracy rate of about 79%. Our neural network, which is the highest, gave us a percentage of over 90%. And then our regression and time series model gave us an accuracy performance percentage of about 90%. Predictive models are popular for forecasting events, but it is also essential to fully understand the models and how to run data against each model, taking into consideration the possible unknowns that can present itself from the past and also can present itself in the future. One of our primary focus was to look at different models and compare the outcome. Looking back at our linear regression and time series model, we can predict at what point during the time frame, that we actually seen our numbers change drastically. Neural network is the most popular of the 3 models due to its high accuracy percentage rate. In our stock market project, neural network model gave our group the highest performance percentage over the data set tested in all 3 models. Thank you.